What is up, people? Welcome to Thursday Investing Thoughts. This is a new regular feature to the Dentists Who Invest page that I've been meaning to do for a while. And what I want to do is, and what I will do is, I'm giving people the real narrative, the real perspective on investing that you should be hearing, but you don't hear because everybody is so focused on the day-to-day stuff, the noise, what is going up, what is going down, the sensationalized headlines, the news, what's going on there. And actually, seriously, there is a huge school of thought out there that says that really we don't have to listen to any of those things. We just have to keep using time honored principles in investing, and when we apply those over and over again, that is what causes us to be successful. And actually, if we listen too much to the news, that is something that's going to detract from our ability to be successful, because we're getting too caught up in what's happening. We're selling when we shouldn't, we're buying when we shouldn't, and we're doing all of the wrong things. And that is why I've created Thursday Investing Thoughts, which is going to be content which is unique to the Dentists Who Invest page. You'll find it here every single week. We're going to be dishing out knowledge on a principle of investing. And as I said, it's going to be a regular feature. Please feel free to leave your thoughts in the comments, anything that you'd like to see in particular. Today, we're going to be talking about mindset. What's up here? Because that is so important, and it is something that still is underrated in the world of investing, still is underrated. What is too highly rated is technicals, people jumping in and out of the markets and trying to do it at the right time, trying to time the markets rather than spend time in the markets. And that is why that most people actually turn out not to be successful, is because they don't understand this underlying stuff. And you know what? I have a huge issue with how investing is depicted in the media. It's depicted as some sort of gambling thing, some sort of gunslinger thing, where we're going in and out, some sort of fast Eddie, shoot from the hip sort of style, where we're trying to make money. And basically, that just does not work. It's the time-honored principles applied over and over again that really do work and literally put money in your pocket. So without further ado, let's go ahead and jump straight into this webinar which I have created. And this is on mastering your mind. Thursday Investing Thoughts, like I say, regular content on the Dentists Who Invest page, fun stuff, and the real narrative of how investing works, not the stuff that you see in the news, not the sensationalized stuff. And you know what? Not the stuff that you see a lot of on YouTube as well, because that is content that panders to what people want to hear rather than what they need to hear. This is the real deal. So let's go ahead and jump straight in. The power of the mind. The power of the mind, so important. There are investors out there are scholars of investing, really knowledgeable people that say, actually, investing is 100% psychology. And pause on that for a second. How crazy is that? So they assert that really, if you master what you have going on in your head, you're a brilliant investor. Now, I don't fully agree with that. I do think there's probably 10% practical skills in there, how to use a platform, understanding, education, and knowledge. But the very fact that people think that or say that in the first place gives you an idea of how important that it is, and certainly it is a huge part. Not FOMOing in at the wrong time, not jumping on the bandwagon, and not selling when people become scared as well. And that's what this webinar is here to talk about today. So the first thing to understand is this is the most brilliant piece of knowledge. This is a flipping gem right here. If you buy certain assets, they only ever go up in value when compared to the pound or the dollar. Pause. Dwell on that for a second. That is one of the most fundamental, important principles that we need to wrap our head around. One of the things that blew my mind about investing when I learned it for the first time was that certain things only go up in value, but we have to understand what those things are. Now, there's a variety of reasons why that happens. And you know what? The essence of it is that we could probably debate that all day. However, the two main reasons are because there's only ever more money printed. And also, as well as that, the world's population only ever goes up. Did you know that inflation is fundamental to how economies work? There has to be inflation. If there's deflation, then what that means is that people actually begin to lose their jobs and businesses go bust. And also, as well as that, when the banks lend out money, the money becomes the money that is owed to them. They actually lose money on it, even though they're charging interest because of deflation, because that money is becoming worth steadily more with time, and they would have just been better off keeping the money. That is the key thing to understand. Okay, that is a massive thing to understand right there. There has to be inflation. For as long as our financial system exists the way that it does, there has to be inflation. Okay, and because of that, because there's inflation, the value of your money goes down and the perceived value of assets go up, because remember, we're measuring it with the yardstick that is cash. Okay, now if I have a yardstick, if I have a meter stick, and the meter stick is getting gradually shorter and shorter with time, and I'm measuring my house, the length of my house, guess what? It's going to take more meter sticks to measure it. Yeah. Now, if I have cash and its value is going down with time, guess what? It's going to cost more cash. It's going to take more cash to measure the value of that house. That's the exact analogy that we should be thinking about in terms of money. We should be using that to understand how the value of these assets continuously goes up, because there's always going to be inflation. Because guess what? When there's deflation, it doesn't work in the bank's favor or the government's favor. People who owe money, they want there to be inflation. People who lend money, they want there to be inflation. A market catastrophe. So let's zoom in right here on this. So, you know, the way we've been having Ukraine recently, all of these things going on, you're going to watch the news, you're going to see this stuff that's flipping sensationalized. It's completely blown out of the water in terms of proportion, in terms of how much it's going to affect or the value of our portfolio long term. This is Ukraine. Okay, this is the red stuff. This is the fallout from Ukraine. This is how much it has affected the markets. Now, what we've done is we've picked the S&P 500 here. Everybody knows I talk about the S&P 500 a lot. It's just a really good way to measure the health of the world economy. That's the point of the S&P 500. As to what it is, let's not get bogged down into it too much, but let's say that it's representative of the affairs of the global financial system. When it goes up, things are good. When it goes down, things are bad. When it goes up, we make money. When it goes down, we lose money. So the S&P 500 is going down. Everybody's scared. Ukraine, Putin, lots of rhetoric. People are threatening that the war is going to escalate, nuclear bombs, all of those things. Okay. It looks terrible, right? Everybody who's bought at this point is panicking and is scared, right? And this is I'm not making this up. This happened a few months ago. This is a developing situation, an ongoing situation. So let's put this into something tangible. 10%. It's went down by 10% in value. Now, if you had £1 million and it went down by 10% over the course of this is 2 weeks, you'd be pretty darn scared. That's 900k where you once had $1 million. Lots of people are going to be scared naturally. That's completely understandable. However, we need to elevate ourselves from that mindset, because remember, that's how everybody thinks, and this is why the majority of people cannot be successful in investing. So what we've done is we've highlighted the fact that this is 10% depreciation over this period of time. What we've done is we put it in this little red box, and now we're going to compare how this looks on the grander scheme of things, and this is going to blow your mind. Okay, remember, this is complete peak fear. This is over the course of 2 weeks. Markets are tumbling, everybody's scared, absolutely terrifying. Fear in the streets, people are panic selling, etc., because they've lost 10% of their wealth over such a short space of time. But this is what we as human beings are really bad at. We fixate on the micro and not on the macro. And really, if you can flip how you think about a few things, you can become a very successful investor. But stunningly, 99% of people cannot do this. Okay, red box. Here's the red box in action. Ring fencing this little area of price movement over these last few months since November time. Now, what we're going to do is we're going to get a real feel for just how big this is, just how significant this is over stocks in the long term. Check this out. Here's the red box. Keep your eye on the red box. Now remember, the red box in the slides I'm about to show you I'm not making the red box smaller. It's consistently showing the same amount of time. It's showing this November to February period. December 1 month, January, February, that's 3 months. All right. Now we're zooming out a little more, okay? And we can see, okay, this doesn't look great. But if I've been buying in all this time, then actually this doesn't look so bad relative to all the gains that I made here. Because guess what? If I'm buying here and here and here and here, then I'm actually still in profit even after all this red stuff. Now then, we're zooming out a little more. Can everybody see where I'm going with this? Check this out. This is over a period of 2 years. Now remember, if you've been in the market for a long time, averaging your way in, all about the time you spent in the market, guess what? You become less and less gradually perturbed because you spent more time averaging your way in. Forget about the micro, think about the macro. Now, this is when things get really crazy, okay? See that little red box up there? That's Ukraine, okay? What's this even scarier one down here? That's the coronavirus crash. Now this blip is being put into proportion. But can you see the trend? Bottom left to top right, it's always going up. Now, bear in mind that box still depicts that same 3 month period. Now you're getting a crazy feel for how this works. Now you're seeing how this works. And guess what? It always goes bottom left to top right. And this is what we must remember. This is the theme we must remember. This is over 20 years, all right? So if we're going in here, we're trying to time the market, guess what? Chances are, if we're going in and out over the course of 2 weeks, we are trading it on way too short a time frame. People say 3 to 5 years if you want to invest in the stock market to guarantee profits, if you're averaging your way in, if you're an investor, which 95% of people are. If you're a trader, it's a different matter, but that requires a whole other skill set. But guess what? How this is moving upwards in time, this is where you want to be. This is where you want your assets to be stored. Something that is consistently appreciating. Yeah, the path is rocky. Yeah, the path doesn't always go smoothly, versus something that is consistently depreciating, i.e. cash. That is the mindset flip that everybody needs to have. You're guaranteed to lose if you keep all of your assets in cash. You have an unbelievably high likelihood of winning if you understand these concepts and if you buy the right things. What are those correct things? That's a subject for another webinar. But all I'm doing right now is depicting how we should be looking at this and picking the right assets, and also showing you how you can consistently win. And you know what? Here's the best thing. These are stocks. They're paying you dividends the whole time as well. If that's in your ISA, the dividends tax-free. Why not just that? They weren't always tax-free in an ISA, but they are tax-free in an ISA. I believe, they are, yeah. But that wasn't always the case. But how cool is that? So you're getting tax-free dividends as things go up. If it's in your ISA, if it's outside of an ISA, that's another matter. But it's interesting. It's passive income. Everybody's seeking passive income. This is one of the ways how. You need a big pot for it to really appreciate and give you loads of money. That takes time, but you got to start somewhere. And this is how you do it. Why? 2 main reasons we talked earlier: money printing and populations increase, populations of countries increase. Whilst those two themes continue, we're always going to have inflation, and we're always going to have more demand on the market, therefore pushing value up and pushing the value of cash down. Now, I'm not saying go out and spend every penny on stocks. This is certainly not financial advice, but what I am saying is that if you educate yourself, this is out there and anyone can do this, and you'd be stunned at how simple it is. It's all about picking the simple stuff. There's 4 main assets at our disposal: stocks, bonds, houses, cash. We pick some of those, or a combination of any one of those, or a combination of those, and we use it to increase our wealth with time. We must understand this concept first. Remember, at the moment, inflation is about 6-7%. We have to actually generate more than 6 or 7% in terms of returns in order to outpace inflation. But the worrying part is that if you keep it in cash, you've got a guaranteed loss of 6 to 7% every year. That is the nuts part. So take comfort from the fact that with time and correct asset, history has shown that you will always win. Obviously, we can't use that to predict the entirety of the future. However, if I've got a guaranteed loser versus something that's highly likely to allow me to win, and know which one I'm going to choose every single time. There's more to it than what I've just given you, a little more to it. But that revelation in itself was flipping earth shattering for me the first time I learned that. And actually, here's the interesting part. You know, a lot of people say, okay, DIY portfolio, I want to do this on my own. I want to create my own wealth management. I want to do it for myself. I want to be my own boss in that sense. I want to be self-employed when it comes to my financial affairs, rather than have an FA. Is another way of thinking about it. It's an interesting one. And I'm not going to say one or the other, DIY or have someone assist you. I'm not going to lean either way. Personally, DIY for me, it is helpful to have an FA, perhaps when you have a lot of assets further down the line. But the interesting thing is that some FAs would even argue that this is one of the greatest purposes or roles that they fulfill, in that they will help you not push that red sell button when things get a little wobbly. And that's why you pay them the 1%, 2% every year, to hold you back from doing it, to hold you, to pry your hands away, pry your fingers away from that sell button on your app, on your phone, on your ISA. And some people, here's an interesting thought as well. Some people as well, they believe that when these apps, this software, which makes everything more accessible for us, was created, it actually works against us a little bit as well, because it makes it so accessible to just go ahead and sell our portfolio when the road gets rocky. So it's just another interesting way of looking at it. Like I said, this is the alternative slant on finance, the alternative slant on investing that you won't hear anywhere else. You won't hear this stuff on YouTube. At least not on the main channels, at least not on the mainstream channels anyway. And I have no idea why, because this is the most valuable stuff there is. And it will cause you to look at investing in a totally different way. Just remember, pick the ones that are only going to ever go up. Design yourself a portfolio, how that looks for you. We're going to get into that on future webinars. Everybody's different. I'm not saying that somebody who is close to retirement should have an all stocks portfolio. Maybe you want to think about mitigating some of the risk of volatility of stocks via holding other assets. Just a thought, just throwing it out there. You probably want to do that, particularly if you're close to 5 years, if you're closer than 5 years to your retirement, or you're already in your retirement, then things change. But everybody outside of that should give that real thought about how they allocate your portfolio. We're going to do another webinar on risk, because risk is a really interesting concept that I know for a fact is misrepresented a lot, and people get the wrong end of the stick on risk all of the time. So in summary, your mindset is a massive part of investing. Understand your psychological profile in order to invest. Think about cash, think about bonds, think about stocks, think about houses. They're your 4 conventional assets. Crypto's in there as well, of course. Nowadays, never let fear or greed determine your actions. And if you do those things and you understand these concepts, you'll be successful. And actually, one of the biggest things about success is taking your hands and doing this, sitting on them and saying, hey, I'm not going to do anything just because I feel scared. I'm not going to do anything because I now feel greedy. I'm certainly not going to sell when everything's going down. Wait till it goes back up and then start averaging my way back in, or buy again in a big chunk until I sell again and the next time it goes down. Remember, that is the certain way, that is the most certain way that eventually you'll wind up broke in the investing game. But it comes from understanding the narrative, which is that cash always goes down in value, and that certain assets only ever go up. And if you can equip yourself with that knowledge, you are so powerful. Thanks so much, guys, and we will see each other next week for another discussion on an amazing principle in the investing world.